I'm often asked what PITI is. PITI is an acronym for the four things that go into making up your house payment: principal, interest, taxes, and insurance. The principal is the amount of money that you've borrowed from the bank. The interest is what they're going to charge you for using their money. The taxes are the property taxes on the property, and the insurance is the homeowner's insurance. So principal and interest are pretty self-explanatory. The interest is going to change based on whatever interest rate you get. It could also change based on if you're doing a 30-year fixed or an adjustable rate mortgage. The taxes are based on the purchase price of the house. In Sacramento County, we're looking at 1.25%, maybe up a little bit higher, 1.5% of the purchase price. It really depends on if you're going to have a Melrose or other bonds and assessments that change neighborhood to neighborhood. So it's always a good idea to ask your agent if you can look into whether this neighborhood has any special bonds or assessments. But most lenders will estimate 1.25% to 1.5% of the purchase price. Homeowners insurance, again, varies depending on what kind of coverage you get. Again, most lenders are going to do an estimate of about 1/3 of the purchase price. So let's take an example of a house that's $200,000. Obviously, your principal is $200,000. Assuming we don't have a down payment, we'll just make it simple. Your taxes on $200,000 based on a 1.5% or 1.25% purchase price. You're looking at about $2,500 for the year. Divide that by 12, and you're looking at about $200 a month, just a little bit more for your taxes. And then your insurance, at 1/3%, we're looking at about $700 or $800, which comes out to be about $60, $65 a month. Again, all these are just estimates, but that's a real quick explanation of what your PITI is.